Canada's position on the developments in the Middle East remains clear. The Islamic Republic of Iran is the principal source of instability and terror throughout the Middle East. It has one of the world's worst human rights records and must never be allowed to obtain or develop nuclear weapons. Canada supports the United States acting to prevent Iran from obtaining a nuclear weapon and to prevent its regime from further threatening international peace and security. And the Canadian government urges the protection of all civilians in this conflict.
Oil surged the most in 4 years as tanker traffic halted through the Strait of Hormuz amid escalating conflict in the Middle East, threatening supplies, of course.
The war in the Middle East has caused global oil prices to surge. Iran, after all, has one of the world's largest oil reserves and has the power to effectively shut the Strait of Hormuz. That is the world's most critical oil trade route.
If you think this war is far away, take another look at your receipt. Because when the United States and Israel escalate a war on Iran, the first missiles may land in the Middle East. But the first economic shockwaves hit ordinary people everywhere through oil, shipping, insurance, currency, and interest rates. And in Canada, that shock arrives with a familiar pattern. A few sectors profit. The currency gets shaken, inflation pressure rises, and households pay the bill. Here's the truth the headlines often hide. Modern wars don't just destroy, they reorganize. They rearrange supply chains, they reprice risk, and they expose which economies are built for people and which are built for extraction. The Middle East is not just a region, it's an energy artery. And one narrow passage in particular, the Strait of Hormuz, has the power to raise prices from Toronto to Vancouver overnight, because the world still runs on oil and gas shipped through choke points that can be threatened, disrupted, or blocked. In the first days of this war, markets did exactly what they always do. They panicked first, explained later. Oil surged sharply, and the Canadian dollar still fell. Let that sink in. Reuters reported the loonie weakened about 0.4% to roughly 1.37 per US dollar, even as oil jumped about 5.9%, a sign that fear and safe haven demand for the US dollar were overpowering the usual Canada benefits when oil rises logic. So Canada is getting a double squeeze. Higher energy costs feeding inflation, and a weaker currency making imports more expensive. This is how war becomes a silent tax. Now let's bring it down to street level. Canada's gasoline prices started climbing almost immediately. GasBuddy's early afternoon reading put the national average around 135.8 cents per liter, rising from the day before and from the prior week, with sharp jumps in major cities like Toronto and Vancouver. And here's the deeper mechanism. Fuel isn't just something you buy at the pump. Fuel is a cost layer inside everything else you buy. When transport costs rise, food logistics rise. When input costs rise, prices rise. When businesses face uncertainty, they delay hiring and investment. And when households are already stretched, every extra cent per liter behaves like a pressure test on social stability. This is why oil shocks are never just energy news. They're a cost of living event. But Canada's situation is complicated by a national contradiction. Canada is an energy exporter, a major one. So when oil surges, a slice of Canada's economy celebrates. Energy producers gain, oil-linked equities rise. Some provincial revenues can improve. In the very same day of market stress, Reuters noted the TSX was held up by energy gains, with the energy sub-index jumping about 3.1%, while other sectors weakened. That's the Canadian paradox. In a global crisis, parts of the economy win while most households lose. And if you want to see the class and regional politics of this shock, look at the map. Energy-producing regions can experience a revenue and investment boost when prices spike. Meanwhile, Energy-consuming regions feel the pain faster through transport, groceries, commuting, and business costs. This is why war-linked energy spikes can intensify internal inequalities inside Canada, between sectors, provinces, and social groups. But the biggest danger for Canada isn't only gasoline, it's inflation expectations. When oil rises and stays elevated, it feeds into broader inflation psychology. People expect prices to keep rising, businesses adjust pricing behavior, and central banks get cornered. And the Bank of Canada has already been warning Canadians directly that supply shocks can force tough decisions even when the economy is weak. On March 2nd, 2026, Bank of Canada Deputy Governor Sharon Kozicki said that persistent supply-side shocks can mean rate hikes may be needed even when growth is weak, because the priority becomes restoring price stability. That statement matters because it tells you how Ottawa and the Bank of Canada are likely to interpret this moment. A war-driven energy shock can delay relief. It can keep borrowing costs higher for longer. It can extend the pain for people with mortgages, consumer credit, and tight monthly budgets. So the chain is simple. War risk increases. Oil and shipping risk premiums rise. Inflation pressure builds. Bond yields respond. And central banks feel pressure to stay hawkish. Reuters reported Canada's 10-year bond yield climbed, and specifically tied the move to inflation concerns connected to surging energy prices and the Middle East escalation. That's not abstract finance talk, that's your mortgage renewal. That's the cost of credit. That's the difference between a family making it through the month or going under. Now, you might ask, if Canada is an energy exporter, why does the loonie fall? Why doesn't Canada get the good version of high oil? Because crisis economics is not just about fundamentals, it's about fear. In geopolitical crises, capital runs to the US dollar. Reuters explicitly framed the loonie's weakness as driven by safe haven demand for the greenback, even while oil surged. A weaker Canadian dollar makes imported goods more expensive. That affects everything from consumer electronics to machinery to certain food inputs. And it can keep inflation sticky. So Canada is being pushed from multiple angles at once. Higher energy prices push costs up. A weaker currency pushes import costs up. Higher yields push borrowing costs up. And uncertainty pushes investment down. That's how a war over there becomes an economic squeeze right here. Now let's talk about North America more broadly, because Canada doesn't move alone. In the United States, Reuters reported that average gasoline prices crossed $3 a gallon, with analysts warning that continued disruption and seasonal fuel shifts could push prices higher still. That matters for Canada, because the U.S. economy is Canada's biggest market. If higher gasoline prices feed political backlash, consumer anxiety and slower growth in the U.S., Canada will feel it through trade demand. So even if energy revenues rise in parts of Canada, the export-dependent parts of the economy face a different threat. Weakening demand from the very market Canada relies on most. And this is where the trade edge argument comes in, the claim that America's involvement can give Canada a business advantage. Yes, there are channels where Canada might benefit. When Middle East supply routes look dangerous, buyers pay a supply security premium. They look for stable supply in politically safer jurisdictions. Canada can benefit from that reputation, especially in energy and commodities, if buyers seek alternatives to Gulf risk. Canada can also benefit from near-shoring logic. Wars and choke point risk push firms toward friend-shoring and regional supply chains. And if Washington wants stable allied supply while it is entangled in conflict, Canada can find bargaining space on trade friction, approvals, procurement, and carve-outs. But here's the Liberation Lens reality check. A trade advantage that comes from war is not a moral victory. It's a structural symptom. It means your economy is still wired to profit from instability, at least for certain sectors, while ordinary people absorb inflation. That's not resilience, that's dependence. Now look at Canada's political posture, because it matters for markets and credibility. Prime Minister Mark Carney and Foreign Affairs Minister Anita Anand stated that Canada supports the United States acting to prevent Iran from obtaining a nuclear weapon and called for the protection of civilians. And on March 2nd, Anand issued a statement calling on all parties to protect civilians and civilian infrastructure and to return to negotiations for a diplomatic resolution. So Canada is trying to present a values posture on paper. Security objectives plus civilian protection plus diplomacy. But legality is where Canada becomes careful. Reporting on March 2nd noted Anand would not say whether Canada views the U.S.-Israeli strikes on Iran as legal. And that legal ambiguity matters, because Canada regularly claims allegiance to a rules-based order. When you support force, but avoid stating the legal basis publicly, you create a credibility gap, and that gap becomes political vulnerability at home and diplomatic vulnerability abroad. Now at another layer, military and logistical involvement. Canada says it won't get involved militarily. Yet Canada also maintains embedded personnel supporting U.S. headquarters in the region through Operation Foundation, about 18 CAF members deployed across UCENTCOM and its components. That's the modern alliance posture, not publicly a combatant, but operationally close enough to be inside the system. And here's why that matters for the economy. Because the deeper Canada is tied to America's strategic posture, the harder it becomes to insulate Canada from America's blowback. If escalation expands, Canada inherits risk. Risk to Canadians abroad, risk to trade routes, risk to energy prices, risk to domestic inflation, and risk to political stability. And even if Canada avoids direct military action, the economic entanglement is unavoidable. Because energy is global, shipping insurance is global, currencies are global, and fear is global. So what does all this mean for the Canadian economy in plain terms? It means Canada faces a high probability of the following in the short to medium term if the conflict persists. Rising fuel costs feeding broader inflation. A loonie that may remain weak if global investors stay in risk-off mode. Borrowing costs that could remain elevated if inflation expectations rise. Sector splits where energy gains offset wider market weakness, but households still pay. And heightened uncertainty that slows investment, especially outside energy. You can already see the shape of it in the market behavior Reuters described. That is, energy up, other sectors under pressure, broader risk sentiment fragile. This is how war reallocates. It reallocates income upward to sectors that benefit from price spikes. It reallocates risk downward to households that can't hedge. And it reallocates political attention away from structural reform toward crisis management. Now here's the bigger question Canada has to confront. Is Canada building an economy that can survive shocks without sacrificing households? Or is Canada still running a model where the country's good news depends on global instability, oil shocks, commodity booms, and alliance privilege, while the social cost is pushed onto ordinary people? Because if the only time parts of Canada feel strong is when the world is burning, then Canada is not watching a conflict. Canada is watching a mirror. And the mirror is reflecting an economy still wired to extraction, volatility, and geopolitical dependency. Peace isn't just a moral idea. Peace is an economic design principle. Peace means insulation from shocks. Peace means systems built to protect people, not just profits. So watch the pump, watch the loonie, watch the bond yields, and watch the language. Because when leaders say security and markets say risk premium, it's ordinary people who translate that into a higher grocery bill, a bigger commute cost, and a mortgage renewal that suddenly feels like a cliff. And that is the Canadian economic story inside this war. This is Liberation Lens.